This has been an interesting period, I think.
To say the least.
To say the least. Never, you write in your note, have markets seen every asset class down for the year outside of a global recession or economic crisis. Yet here we are. Why and what's going to change that?
Well, there's a fundamental story for commodities. I'm going to say they're misbehaving because equities should be down right now, higher rates, and they have that rate growth trade-off. So that's par for the course. Bond markets, FX, everything else is relatively stable. It's commodities that are the outlier here. And there was a fundamental triggering event. One was the Iranian sanctions, waivers for the Iranian sanctions. And then you have concerns over demand, particularly in China right now. But the movement in oil prices far surpasses any fundamental drivers of that magnitude. And the question then becomes, what was driving the oil price? It was positioning. We don't have discretionary investors in these markets anymore because the ability to assess risk, whether it's around U.S. foreign policy or around an indeterminate trade war, has discouraged discretionary or fundamental investors. What's left over? Systematic traders. They drove the market down to extreme levels. We triggered what we call a negative gamma event, blew through the put strikes of hedging programs. We're at the most dislocated I've ever seen this market.
All right, so simply put, we don't have as many active managers pursuing commodity-led strategies. Their AUM has declined, and so you got computers running everything.
Exactly.
All right, so what changes that fundamentals start to then override this?
What makes commodities unique is they're attached to a physical market. And when you have dislocations of this magnitude against the physical markets, they ultimately will be corrected or disciplined by the physical markets if you don't see discretionary money come back into these markets. What would be the catalyst? We think this G20 meeting this coming week really could be that catalyst. They're going to discuss two big important drivers. One, U.S.-China relationship, and then you're going to discuss between Putin, the Crown Prince of Saudi Arabia, and Trump a potential OPEC plus production cut. We think a production cut is in the interest of all three parties. Oil prices at $50 a barrel dig into the U.S. industry's cost structure. It's not good for the U.S. either at these price levels.
Where do they want it? Where's the magic price for them? For them and for us?
In terms of thinking about the equilibrium price in that $65, $70 a barrel range, our target for the end of next year is $70 a barrel, which is substantially higher from these levels. But when you're in that level, it's not too high and damaging the consumer, but at the same time, it creates a stable environment for the industry.
I get that the world is awash in oil right now. You got record numbers being pumped out of the ground here in the U.S., potentially record numbers in Saudi Arabia right now. Are there any actual tangible signs that demand and consumption is waning? That's
the important question. The answer is no. Yeah, you can find some very idiosyncratic stories, like demand in Germany is weak. There's a lot of, the Rhine River is low. I can point to that. You have problems in petrochemicals in some parts of the world. But if we look at overall demand across every single commodity, there's no indication we have recession-like demand, which goes back to that point. Why are commodities underperforming and not delivering the late cycle performance we typically see? It really is positioning.
Jeff, why are you optimistic on the G20? And as well, given what the president seems to tweet all the time about loving low oil prices, why be optimistic that he would agree to some sort of production cuts?
Because at this point right now, you're at levels that if you go any further, you start to create problems for the U.S. One, the cost basis for shale is somewhere between $50 and $55 a barrel. We're below that level at this point.
It's really that high?
What?
It's really that high? I'm surprised to hear that.
Yeah. In terms of looking at the all-in cost, including the return on capital, you're somewhere in that $50 a barrel. We are down now digging into that cost structure. Now, the other point, too, is we take high-yield market. The high-yield market, 15% of the issuance is tied to energy. You go below $50 a barrel, you create problems in high yield. This spreads and becomes a much larger problem than just a commodity market problem. It becomes a credit market problem. We don't want to see that.
If we've crossed into through the looking glass on this discretionary investor going away, what brings him back? Are we in this for good?
Yeah, and one is confidence in the underlying fundamentals. Like I say, at this point, the discount in prices is offering hazard pay for somebody who wants to come back into these markets. The response we got this morning on the note was, it was more like everybody was asking everybody else, what do they think of that note? Which I think it really is an indication how fearful the market is of coming back in, despite the fact that the underlying disconnect between fundamentals and prices is so large.
Okay, again, so you do expect the administration to change their tune on oil prices to some extent, is what you're saying.
Yeah,
because somebody's going to get the memo that it's not necessarily good.
It's not very good for the U.S., in terms of thinking about if we go much lower from here.
And then you are positive on what will come out of the G20 with China, because why?
Because if you look at the duress that the current trade war is imposing on Chinese growth, in fact, iron ore is down because you got problems with the steel mills this morning. They are going to want to come to at least a pause. So, we put a 40% probability we get a pause out of this G20, a 10% probability you get a deal. So it's a 50-50 proposition going in. You end up with something better off than what you had at the beginning of this week.
Natural gas, the wild moves, the volatility, the widowmaker trade we've been seeing. What do you say to investors right now?
We want to short natural gas. You saw, again, a lack of liquidity. You had short vol positions in natural gas going into 2 weeks ago. You unwound it. Market spiked tremendously. It's well above what fundamental fair value. And one of our top trades is 2 short time spreads on natural gas. And it's warm out today. We're down, 20 some odd cents already today.
Jeff, a lot to keep track of here. Appreciate your coming on and coming on frequently.
Yeah, commodities are entertaining these days.
That's right. Entertaining is one way to put it. Jeff Currie from Goldman Sachs.